Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have with us Bob Fraser, who is pretty much a veteran and founder of Aspen Funds. They focus on a variety of things, so really excited to jump into things. He has a pretty impressive finance and tech background, UC Berkeley alum in computer science as well. So, Bob, what's going on today? How are you doing?
Well, we're just having a heck of a time enjoying this incredible market. And going super well.
Perfect. So I hit on it a little bit, your background, but why don't you just tell us, in case our listeners aren't quite as familiar with you and your background, what kind of brought you to today?
Sure. Well, long journey. Very, atypical, I guess. I was got a computer science degree. I'm a computer programmer for 15 years and literally wrote code and loved that. And then started a tech business in the mid 90s. .com ended up raising $44 million in venture capital, ended up becoming this, really high growth company. We're the fastest growing business in the Midwest region of the United States in the late 90s. And ended up winning the Ernst & Young Entrepreneur of the Year Award in 2000. And just prior to my IPO, when I was going to be, the next Elon Musk or the pre-Elon Musk, I lost everything, and we got creamed in the .com debacle. And learned a lot through that process, and really became a finance guy at that time. And at that time started dabbling in real estate a little bit. And really the public markets are very, very fickle. And it's very difficult to have rational investment strategies in the public markets. And so I decided something that would fit my computer science need for rationality, right? And real estate is much more predictable. And I met my partner about 10 years ago, and we started Aspen Funds. And we started in the note business. And this was on the heels of the Great Financial Crisis, where there's a ton of distressed debt. And you could buy debt at very attractive discounts. That there was these, if you knew what to do, these were very good assets. We started there, and just very small, and we've been scaling up. Today, one of the largest note operators in that space. And recently, with what's happening in the world, we're very interested in just general real estate. We think there's incredible opportunities in real estate. We called the bottom of the housing market in 2013, and that's when we positioned in the note space as a very risk-adjusted, very attractive risk-adjusted way to participate in notes or in residential real estate. And we've been predicting now the real estate boom for the last 5 years. And so we're also very bullish on multifamily, self-storage, industrial kind of assets. So positioning there as well.
Okay, perfect. So and on your website, you'll mention a few different note funds, but before we started recording, you mentioned that you're also getting involved in a number of other asset classes. So could you kind of expand on that?
Yeah, well, so, of course, the big news is inflation, hitting, 8.5%. Well, if there is a super investment, that has superpowers in inflation, it's real estate. And especially commercial real estate, because it's all priced on net operating income, right? So multiply your net operating income by, let's say, 20, and that's the value of the property. So every dollar of earnings that you increases $20 in value to a property, around that at a 5% cap rate, right? Well, so what happens? Inflation is your best friend. Now, no one is excited about inflation, right? It's harmful. It's difficult for a lot of people. But on the other hand, if that's the way the winds are blowing as investors, we can either complain about it or or position ourselves to not be hurt by it and benefit from it. Well, so at an 8.5% inflation rate, basically in 10 years, your net operating income will go up more than 2 times, 2x, which means the value of that property multiplied by 20. So the value of that property goes up incredibly in example, multifamily real estate. Meanwhile, in high inflation, a dollar is on fire, right? Every dollar that is in your savings account or under your mattress, light a match. I mean, it's losing 8% of its purchasing power every year, right? Well, that adds up. And so in fact, in 10 years at 8% inflation, the value of that dollar under your mattress is half what it was, half. So light your savings on fire. And so one of the best ways to get rich in high inflation is not only to have your income that scales with inflation, but to also borrow money to do it, because you want to not have money under the mattress. You want to have negative money under the mattress, short money, short cash, which is borrowing. In fact, inflation is a massive transfer of wealth from savers to borrowers, right? Savers get massively hurt in inflation and borrowers get massively benefited in inflation. Now that should be no big shock to anyone who is watching our national debt, right? I mean, who's the biggest borrower? Who's going to get the most benefit? Our government. And, one of the reasons why I've never been a guy who's worried about the national debt. And that's the reason. A little bit of inflation makes it all go away. And because the tax revenues go up with inflation and the debt goes down basically, relative to the income for sure. So real estate is a super investment. We're super bullish on multifamily, super bullish, like I said, on industrial. So multifamily, there's a huge shortage. Not only is it just a good investment from just the financial metrics I've said, but there's massive shortage in housing. And it's still a massive shortage, even with all the building that's going on. Well, the same thing is going on in industrial. What people don't realize is that especially large industrial, let's say 250,000 square feet and up of warehouse and manufacturing space, it's tighter than a drum. And it has been underbuilt for 15 years, just like residentials. And the e-commerce boom has sucked up everything that's been available. There's been very little newly built. The e-commerce boom has sucked up whatever was built. And now add the reshoring demand where people are saying, you know what, I'd rather manufacture in America, right? You can avoid the shutdowns and all this other stuff. And I want to inventory in America. So there's a huge shift there. It's tighter than drum. We wanted to play this as investors. Our strategy as Aspen Funds, our strategy is one, identify the macroeconomic trends in place, right? We want to know, and this comes from my background in tech, right? So I figured out if you had a .com in 1995, it didn't matter how crappy your .com was, you were going to make money, right? If you had an awesome .com in 2001, it didn't matter how good it was, you're going to go down. And so what I figured out is it really matters what time it is. And the best investment you can make is really based on timing. So when the tides are coming in, all boats float. When the tides are going out, all boats sink. And so a lot of people focus on the best boat, and yeah, let's have the best boat, but I focus on the tides. And what tides are doing, then it creates margin for error, right? Then it creates, I can make a mistake. I can have something go wrong and I'm still going to make money. I'm still going to do well. So based on all that, so we're looking at multifamily from a macro perspective. We love it from a macro perspective. We're loving self-storage, same thing, macro perspective, industrial from a macro perspective. And so we're looking to play these, and industrial is unique. We went out to start buying, figuring out how to invest, and there's nothing to buy. There's nothing for sale. Large, it's all gone, and it's all, bidding wars and massive shortages. We figured, well, you know what? Let's build it. And if you can't buy it, then sell it. And and the margins are nuts. I mean, buying land, getting, concrete tilt up walls, and it's not expensive. It's very quick to build, and the margins are insane. And so I love insane margins, right? Because insane margins can make genius out of anybody. And again, there's insane margins means margin for error. There's anything can go wrong, everything can go wrong, and I'm still going to make money on that deal. So we're very bullish on those kind of deals as well. So I have a couple of those in the cooker, and some self-storage repositioning in the cooker, as well as our traditional note funds that are just killing it right now.
I was curious. You said it's best to borrow in an inflationary period like right now, but so as a note investor, are you like on the wrong side of the table there? I mean, you just said you're killing it, so could you just explain that interaction there?
Yeah, I mean, yeah, you don't. So bonds right now are not a great investment, right? For you do the math. It's like interest rates go up. The price of debt goes down, inversely to the interest rates as interest rates rise. So yeah, you definitely don't want to be in the traditional debt space right now, but we're not in the traditional debt space. Okay. So we're in the distressed debt space, and the distressed debt space is very lucrative. So we buy at discounts. And so that's the critical thing. So what's actually, it's been a kind of a Cinderella ride for us. We bought distressed debt back, starting in, 2012, and in the great financial crisis, of course, it's super good there. Today, it's still good because we still buy at discounts. I mean, we'll buy a reperforming note, $100,000 note, borrower owes us $100,000, and we'll buy that at a 30-40% discount. So I'm earning very high yields. And then when they refinance, I get a payoff. So it's like a perfect scenario. So I buy at discounts, and that's the reason why I'm less sensitive to interest rates, and they're less meaningful to me. And we're also buying, these are trading. There's typically higher coupons. So these are 7% notes, sometimes 8% notes. So they're already high yield, but add my discount. So let's say I buy a 7% note, but I bought at a 50% discount just to make the math easy. Well, I'm getting a 14% yield on that, right? And every month as they're paying me. So I'm not the property owner, I'm the bank. So I'm the guy they write their mortgage payment to. So a 14% discount, I'm okay with that, right? But then it gets even better. So let's say that's a $100,000 note I paid $50,000 for. Well, when they refinance, it's actually a profit for me. It's a capital gain. So I make 14% cash on cash until I make 100% cap gain. I double my money. You follow me? So those dynamics, are not changed by our current industry environment. So it's still very, very good. We are seeing less distress in the markets. So it's, there's not as many notes to buy, is what that means. So these funds are very gated right now. All our funds are waitlisted right now on note funds, because we have way more investor demand than we can actually place into note purchases. So they're doing super well. They're making great returns, but they're very difficult to scale right now. Of course, there'll be another market cycle at some point, and the distressed debt will pile up again. And there's always something that's working, right? Doesn't matter what time it is. There's always something that's great.
Yeah, that makes a lot of sense. So we actually had a guest. His name was Chris 70. He was an earlier episode on the podcast, and he does the same thing. I don't think he necessarily branches out into the other types of property types, but does a lot of note investing. It was a really interesting episode. But I know on that one, he mentioned PaperStack was a website you go to either buy or sell notes. But are y'all just directly working with banks to source these notes, or working through note brokers?
Yeah, we have probably 50, 60 sources that we buy from. We buy mostly large pools. Most of it comes through brokers and, hedge funds. Lots of relationships there. We do use PaperStack. I don't think we've ever bought any notes from PaperStack. We do sell notes on PaperStack, and it's a good place to buy notes, I suppose, if it's one or two at a time. I don't think they do a lot of pools, But yeah.
Okay. Yeah, because that was also my next question was, I know you're doing it on a larger scale than just maybe an individual investor using his own capital. So how many loans are you usually purchasing when you're doing, because you said you're bundling them up when you say large pools, right?
Yeah, I mean, anywhere from we'll buy pools of a dozen or a couple dozen notes all the way up to hundreds. I mean, and thousands. We bought 1,000 notes during one purchase. So we'll buy as many as we possibly can. Whatever, obviously the larger the better. So
Okay. Yeah, I'm familiar with the tranches and mortgage-backed securities and potential cross correlation. So do you all ever have issues like that, or does it not really matter as long as it's fitting a certain profile in the aggregate?
you mean, do we buy like securitized notes? Is that what you're asking, or what's the question?
No, yeah, so it was more related to just credit quality, because if you're buying that many notes at one time, how are you underwriting that?
Oh
Is really
yeah.
the question.
Well, every note is individually underwritten.
Okay.
So yeah, we're very, very sophisticated underwriters. We've been doing this a very long time, and we know all the tricks. And we're kind of math weenies. So we, for example, and when we buy a reperforming note, so these are notes that were once a bad note, not being paid. Someone fixed them. They got a loan modification. It's now a new note that is being paid, and so these notes, they're being paid, but so we look at every possible outcome for this note. So let's say it's a second mortgage. Well, they stop paying on the first in year 2. Let's say they refinance in year 3. Let's say they stop paying on the second mortgage in year 7. So we look at every possible outcome of this note, right? Every single scenario, every single one. And there's about a dozen scenarios. And then we come up with a cash flow for that payment stream. Here's how much money is going to come in on that note in this scenario, right? And then we do what's called a discounted cash flow. Okay, it's kind of a math thing, and it says, okay, based on this set of cash flows, here's what that's worth today at this discount rate. So we come up with it's a net present value in essence, and so we come up with a dozen net present values, and then we weigh those based on the probability of based on our experience of what's really going to happen to this note. And we typically underwrite to a 30% default rate, meaning a 30% likelihood of default, which we've never come close to experiencing that. Even it does, never. The effective default rate during the great financial crisis, you know what it was? 5%, 5. So we're underwriting to 30. So that gives us kind of the mathematical value of this note, right? It's basically, let's call it the intrinsic value. It's what this note is worth. That we have never yet paid that for a note. We've always are less than that price when we buy a note. We buy it less than the intrinsic value. So again, super sophisticated underwriters. And for example, one of the metrics we look at that I don't know any bankers that look at, it just makes sense to us, is we look at the PITI relative to the equivalent rent. So what if the homeowner who's paying their mortgage, and that mortgage is 50% lower than the rent they would have to pay in that same house? So they're paying $800 a month on their PITI, but if they were to rent that house, they'd be paying $1,600 a month. Are they going anywhere? Are they going to, they're not going anywhere. And so we look at things like that as our key underwriting metrics. And again, we're very, very clever. We've been in this a very long time. And and this fund, I mean, even through COVID, our flagship reperforming note fund just sailed through COVID. I mean, with not even a hiccup, and kind of surprised us, to be honest. I mean, we have really built it to be bulletproof, having gone through as many cycles as I've gone through. We really wanted to design something that was just flipping bulletproof, and, it's arrogant to say, it is, but honestly, we tried everything we could to come up with a model that is just going to weather any storm and is be able to maintain high yields through any storm. And so far, it's proving out. 10 years in, right? So not bad.
Yeah, it's really interesting because eventually the music has to stop in any cycle. Although right now it seems like it's not going to stop in the near term.
Yeah, but does it anymore? I mean, it's bizarre, right? With modern monetary theory and the ability to just continue to pump cash in. I mean, with the COVID thing, I'm a student of economics, and we're we pay a ton of attention to economics. We do our own research on reports because it informs our investment, and because we want to understand where the tides are going. And we've made very great predictions in the past that have made us a lot of money. But if you look at what's happening right now, I mean, we should have had another massive recession with COVID. What happened? And they printed into it massively with two things that they've never done before, right? It used to be stimulus was simply, hey, let's lower the interest rates, which created better investment metrics. And, maybe there was some trickle down. There was trickle down, but then, they shifted to quantitative easing, which was now let's go into the markets and buy debt, buy rates down and buy mortgages. And that was, of course, they pioneered that in 2009. And then this last one, they did that, and they literally helicoptered money to individuals, drop money into people's bank accounts. I mean, this was a theory in the Ben Bernanke days. Everyone theorized what would happen, and they did it. Well, we know what happens. It's like a freaking adrenaline shot to the heart of the patient. I mean, I don't know if you realize, but the net worth, household net worth in America is up 20% since the beginning of 2020. Household net worth up 20%. Household net income for the average American up 15% since the beginning of 2020, all because of stimulus. So, I mean, and consumer demand is off the chart. And that's why we're having such inflation. You have this incredible consumer demand in the face of supply chain issues. Well, hello. I'm just so glad they didn't do that other stimulus, as we'd be, creating massive trillions of dollars of new demand in the face of already an employment crisis, the shortage of workers and shortage of materials. Oh my gosh, these politicians, they need to take economics 101, it just the insanity. But anyhow, with where does the economic cycle going? What's going to happen in the next crisis? We can predict, can't we? They're going to the market and buy freaking bonds, buy the interest rates down to zip, and then they're going to helicopter more money to people. And by the way, which is pretty good for politicians if you want to vote, right? If you want to capture some votes, yeah, who's going to argue against that? And of course, the downside is, as we're experiencing now, is inflation. But inflation has secret benefits if you're a big debtor like the government. So, solve the national debt crisis. I mean, you see already Treasury revenues are up strongly, right? And the deficit, right? The deficit, the shortfall is crashing, because of all this increased revenue. So anyhow, what's going to happen to the business cycle? I mean, this thing has been going on since 2009. And who's to say it's not going to keep going? When does it really end? As long as you can keep spending into it, right?
Yeah, that's really interesting. And yeah, I was actually listening to your podcast earlier this morning. I heard you mentioning that household net worth being up. It's just really fascinating stuff. Like you said, it's kind of unprecedented times.
It is. And anybody who's looking at the past for guidance is, no one wants to say this time is different, but I'm telling you, it's a different world. And modern monetary theory is a different animal than it's been in the past with the, Australian or Keynesian, whatever school people are in. This, and it's working, right? At least at some level. So.
Yeah, that makes sense. So your funds are, I was trying to understand from your website, are they primarily like 506c offerings, or how do you structure those usually?
Yes. Our note funds are all 506Cs. We're doing a lot of our real estate funds are 506Bs. So we are allowing, up to 35 non-accredited investors and, into those. So those ones are typically not on our website for obvious reasons. So, well, maybe not so obvious, for legal reasons. So you're not allowed, with 506Bs, you're not allowed to do general solicitation.
Right, and you have to have at least like 3 conversations with the investor if they're a sophisticated investor but not accredited. Is that correct?
Right. So what we're doing is we have long, 10-year relationships with our investors. We have some 450 accredited investors. So we make a few phone calls and typically they're funded up. So yeah, we want to have those. We have a lot of relationships, I guess.
Okay, that makes sense. And currently, are y'all raising capital for any of the funds?
Yeah, it's we just completed two multifamilies, really nice, sweet deals. Those were funded in about 24 hours each. So we're just getting ready to do a giant self-storage conversion. Super pumped about that. That's already been fully committed. Again, in about 48 hours. It's awesome. It's an old strip mall and 45,000 square foot strip mall. And we're going to be bigger than that, 100,000 square foot strip mall. And we're creating 120,000 square feet of self-storage. And this got tax abatements. The numbers are insane on this thing. I mean, it's going to be like a 3x for investors. And that's even with really conservative numbers, just to show you how the development side is right now. It's, and then we've got some, the things that are yet in the cooker. We've got 2 industrial builds that we're getting ready to do. And we haven't yet raised for those. So yeah, if anybody's interested, they should go to our website and just get on our investor club so they get the emails. A lot of the stuff we don't even have time to put on the website and it's gone. So
it's really helpful background and context. So it's good to know. And also good to know y'all are doing the 506B so someone doesn't, rule themselves out. Oh, I'm not an accredited investor, can't get involved. So
yeah, we can make a few, get a few of those guys in, and I got my sister-in-law in, I got my mom in, and it's great to be able to do that for people because these alternatives are, they're so superior in so many ways to public markets, and great tax benefits, and we avoid all the volatility of the markets, the public markets. They're so superior in my book, and it's such a shame that the government, makes it where the little guy can't play. And so this is a way for a little guy to play. And it's very difficult to find 506B offerings. No one wants to do them because there's, you can open yourself up to risk as an operator. So we do some of those.
Okay. What's the typical minimum investment on those?
I think some of them are down as low as 25,000, and we can waive it. If you're a nice person, So there's a lot of benefits to being a nice person.
Yeah, okay.
we really can. I mean, I think I've waived it, good number of times for folks. So if there's a smaller investment and you want to help, you want to make it available to somebody, but we don't want to take a whole pile of all of someone's net worth. We don't want to do that, even if the deal looks insanely good, right? We don't want to be that guy, but yeah, we're happy to we can waive it sometimes.
Okay. And y'all usually have like a 5-year holding period, or what's y'all's horizon?
Yeah, it's usually 3 to 5. Most of our stuff, because we see so much opportunity, we're very much focused on velocity right now. So we're putting 5-year plans in place, but looking to exit in 18 months to 60 months, or even 36 months. Just because the market, if we can meet our returns, our 3-year returns in 18 months, we're out, and take the risk off the table, take your money and go put it in place somewhere else. There's too many good opportunities right now. So we're favoring velocity right now. It's in our market. We believe that's the best strategy.
Okay. That's great. I had one other question I was thinking, but overall, I think it's really encouraging to have this conversation. Today's actually my last day at my day job. So you never want to leave the day job going into uncertain economic period, this is like, it's the writing's on the wall. It's like, this is the time, if ever, to leave the day job and fully commit yourself to the business. So
Yeah.
excited.
Well, congratulations,
Thanks.
Mason. And it really is, a lot of people are afraid, but I'm telling you, inflation is magic for real estate. And let's just play it out. Let's say inflation continues at 8% for 10 years. I mean, we run the numbers of your NOIs, they're just going to be insane. And we're going to make so much money. And as long as that thing can track inflation, and even if there's a recession, let's say interest rates rise, vacancies go up, it's difficult to refinance. All you have to do, if you can hold on to that property, meet your debt service covenants, and hold it for 10 years, shift your horizon from a 3-year or 5-year to a 10-year horizon, inflation solves every woe, right? And so we're very much focused on plan B as well in all of our properties, and you want to be super careful today. A lot of the large multifamily operators are using bridge debt, and which is, adjustable rates. They have they buy down on a 3-year cap. But then what happens if in 3 years, rates are up, or 3 years, they can't refinance, right? Well, this is when, equity investors can get creamed. And so we're very much focused on every property we're going into as a plan B, that if the stuff does hit the fan, we can shift to a long-term horizon, and our investors are going to do just fine in the short term and make bank in the long term, no matter what. So again, we're trying to be super smart with the economic environment that we've been dealt.
All right, perfect. I do remember the other question I was asking. You said you have 2 industrial builds. So I was curious in terms of the minimum acreage and square footage y'all usually consider, say for these 2, for example. What do y'all look at?
Well, the markets are telling us that the larger the better. So there's pretty much nothing 500,000 square feet and up, and that's what we're going for. I think we're going for 350,000 in one location, and it'll be about 2 million in another. So we're going very large, and because there's just nothing available, small or light industrial, there's some of that available. But if you're big company and you're trying to get a big space, there is just nothing out there, nothing available. And so we're definitely focused on the larger side, and this is what the market is telling us. Again, we're macro investors. We're not, we're not in love with anything. We're in love with whatever the tea leaves are telling us to be in love with. And right now the tea leaves are saying large industrial. So we've got a nice runway. We've got a good 3 to 4 year runway in that space. There's actually quite a bit of building going on, but there's still incredible demand, and that demand is not going away.
Okay, great. So I think that I've hit on most all my questions. Don't want to keep you all day here, although we could probably talk all day. So you mentioned folks go to the website to learn more about you, sign up for the investor club. What is that website?
It's Aspen, like the tree, sorry, funds, funds.us.us.
All right, perfect. And is there an email or any other information you want to leave for our listeners if they want to reach you, or just go to the website?
Yeah, we have some great, if you're interested in the economics we've hit on, and we have economic blogs up there, and you should get on our podcast, investlikeabillionaire.com. And we really are educating about alternatives and economics, and it's great to figure out how billionaires are doing it and model our techniques after what they're doing.
Definitely, yeah. Like I mentioned before we started recording, I really have enjoyed listening to those episodes. I think it's bringing a new flavor to the podcast world in real estate investing. I really enjoy it. Some of the caliber of folks as well you are bringing on there. So
yeah, thank you.
Sure. Yeah, no, I'll be sure to put those links in the show notes as well for people to
very good
go over there. So great. Yeah, thanks a lot for the time, Bob.
All right, thanks. And good luck in your big adventure.
Thank you. It's been quite the journey, but I'm really excited. It's been almost 2 years in the making of this plan. So it's a whole new chapter and it's exciting. Gonna have
Very good.
Wind in my back. It's great. Thanks.
All right. Take care.
All right, that's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom, and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON at scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.